What caused the crash? Nobody saw it. Opening the markets opened normally that Tuesday morning. Coffee brewing, traders logging in, algorithms humming. By noon, $4 trillion had evaporated. By close, the global financial system was on life support. Governments scrambled. Central banks panicked. The media called it unexpected. But was it really? Nobody saw it coming, or nobody wanted to see it. The pattern is always the same. Let's rewind. 1929. Black Tuesday, the Roaring Twenties, had convinced everyone that prosperity was permanent. Stocks only went up. Debt didn't matter. Speculation was genius. Then reality arrived like a sledgehammer. Banks collapsed. Millions lost everything. Breadlines stretched 4 blocks. Fast forward to 2008. Subprime mortgages packaged as AAA securities. Lehman Brothers imploding overnight. AIG needing a $182 billion bailout. Nobody saw it coming, they said, except the ones who did. Michael Burry saw it. The Big Short wasn't fiction, it was prophecy ignored. History doesn't repeat, ... but it rhymes, and right now. The rhyme scheme is deafening. The foundations were cracking. Picture this. A skyscraper built on sand. Each floor added more weight. Each year, more leverage, more debt, more fragility. The foundation crumbling slowly, until one day, one crack, one tremor, and the entire structure comes down in seconds. That's the global economy in 2025. Total global debt, over $315 trillion. That's 336% of global GDP. In 1999, it was 246%. In 2008, it was 280%. We learned nothing. We borrowed more. We inflated bigger bubbles. We called it recovery. The U.S. national debt crossed $36 trillion in 2024. Interest payments alone exceed $1 trillion annually, more than the defense budget. More than Medicare. The debt grows faster than the economy. Compound interest is no longer working for us. It's working against us. But debt is just one fracture line. The everything bubble. Remember? The dot-com bubble? Tech stocks trading at 200 times earnings because they had .com in their names. It popped. $5 trillion vanished. Remember the housing bubble? Homes in Las Vegas flipping 3 times in 6 months. Adjustable rate mortgages handed out like candy. It popped. The Great Recession followed. Now, we have the everything bubble. Stocks at record highs while earnings stagnate. Real estate prices disconnected from wages. Cryptocurrencies swinging 30% in a week. Meme stocks defying fundamentals. Private equity inflating valuations with cheap money. Zombie companies, corporations that can't cover their debt payments with operating income, now represent 20% of all publicly traded firms in America. They survive only because money is cheap. Rates near zero for over a decade trained everyone to borrow, speculate, gamble. Free consequences were postponed, but nothing is free. Everything has a price. And the bill ... is coming due. The central bank trap. March 2020. COVID hits. Markets collapse. The Federal Reserve responds with the most aggressive monetary expansion in history. $4.5 trillion printed in months. The European Central Bank follows. The Bank of Japan follows. China follows. The entire world hit CTRLP. It worked. Markets recovered. Stocks soared. Housing exploded. But at what cost? Inflation, real inflation, not the sanitized CPI, returned with a vengeance. Grocery bills up 25%. Rent up 30%. Energy costs doubled. The middle class squeezed into poverty. Savings accounts yielding 0.5%, while inflation runs at 8%. That's not a return. That's confiscation. So, central banks raised rates. Fastest hiking cycle since the 1980s. And here's the trap. Raise rates too much, and you crash the debt-fueled economy. Keep them too low, and inflation devours purchasing power. There is no good option, only bad and worse. This time, ... It will be worse. The dominoes start falling. It started quietly. A regional bank in the Midwest, rumors of insolvency, a bank run, FDIC steps in. Isolated incident, they say. Then another bank in California. Then one in Europe. Confidence cracks. Liquidity freezes. Contagion spreads. Imagine waking up tomorrow and your bank account is frozen. Not hacked. Not closed. Frozen. Temporary measure, they say, to ensure stability. You can't access your money. Direct deposit still goes in, but withdrawals are limited. $500 a week. Maybe. Sound impossible. Ask Cyprus in 2013. Ask Greece in 2015. Ask Lebanon in 2019. It's happened before. It will happen again. The system is built on trust. When trust evaporates, so does liquidity. And without liquidity, everything stops. Supply chains seize. Businesses close. Panic spreads faster than truth. The geopolitical powder keg economics and geopolitics are inseparable. War is expensive. Peace is profitable. But the world in 2025 is neither at peace nor fully at war. It's in the danger zone between Russia and Ukraine, Israel and Iran, China and Taiwan, North Korea and ... Everyone. The Middle East, on edge, energy markets volatile, supply chains weaponized, sanctions flying like daggers. Every conflict disrupts trade. Every disruption raises costs. Every cost pressures margins. Every margin squeeze leads to defaults. Defaults lead to failures. Failures lead to panic. And then there's the dollar. For 80 years, the US dollar has been the global reserve currency. Oil priced in dollars, debt issued in dollars, savings held in dollars. This privilege allowed America to print money and export inflation. The rest of the world absorbed it. But the world is tired. BRICS Brazil, Russia, India, China, South Africa now represents 36% of global GDP. They're trading in local currencies. Bypassing the dollar, Saudi Arabia signs oil deals in yuan. Russia and China settle in rubles and renminbi. The dollar's dominance is eroding. If the dollar loses reserve status, interest rates spike. Inflation explodes. Living standards collapse. It's not a question of if. It is when. Barra. It is when. The warning signs everyone ignored. Yield curve inversions. Historically, when short-term rates exceed long-term rates, recession follows within 12 to 18 months. It inverted in 2022. The clock is ticking. Corporate defaults rising. Bankruptcies accelerating. Consumer debt at all-time highs. Credit card balances over $1 trillion. Auto loan delinquencies climbing. Student debt crushing an entire generation. Layoffs spreading. Tech giants shedding thousands. Finance firms restructuring. Retail chains closing. The gig economy fraying. Job openings falling. While unemployment resides recipe for stagflation, but the media stayed optimistic. Soft landing, they said. Resilient consumer, repeated. Markets kept climbing. Everyone kept dancing until the music stopped. The crash. How it unfolded, nobody knows the exact trigger. Maybe a sovereign debt default. Maybe a major bank collapse. Maybe a geopolitical shock. Taiwan, Iran. Something unexpected. The spark doesn't matter. The kindling was already soaked in gasoline. Day one, panic selling. Circuit breakers triggered. Markets halted. Crypto plummets 40%. Gold surges. Treasury yields spike as investors flee risk. Day two, banks report technical difficulties. ATMs run dry. wire transfers delayed. Temporary, they promise. Nobody believes them. Day 3. Governments announce emergency measures. Deposit insurance limits raised. Bailouts prepared. But trust is gone. The bank runs accelerate. Week 2. Supply chains collapse. Trucks stop moving. Shelves empty. Not because there's no food, because there's no payment system that works. Credit frozen. Cash scarce. Barter returns. Month 2. Unemployment spikes to 15%. Foreclosures explode. Tent cities expand. Protests turn violent. Governments impose capital controls, borders tig-ten. Nationalism surges. Sound extreme. Ask Argentina, ask Venezuela, ask Zimbabwe. Economic collapse doesn't announce itself with sirens. It creeps, then pounces. The hidden architects hears the uncomfortable truth. Crashes don't happen by accident. They're features, not bugs. The 1929 crash allowed consolidation of banks and industry. The Great Depression centralized power in Washington. World War II restructured the global order. 2008, the biggest wealth transfer in history. Trillions in bailouts to banks. Quantitative easing that inflated asset prices. The rich got richer. The middle class got debt. Cui bono? Who benefits? Follow the money. BlackRock manages over $10 trillion. Vanguard and State Street together? Another $15 trillion. 3 firms with interlocking ownership of almost every major corporation. 3 firms advising governments on monetary policy. 3 firms positioned to buy distressed assets when everything crashes. The Rockefellers understood this a century ago. Own nothing, control everything. Through foundations, NGOs, think tanks, they shape policy without holding office. Today's elites operate the same playbook. The names change. The game doesn't. Crashes redistribute wealth, from the many to the few, from the middle class to the asset holders, from the unprepared to the positioned. Nobody saw it coming, or nobody was supposed to see who orchestrated it. The aftermath. What comes next after the crash comes the reset. That's not conspiracy, it's history. After 1929, the New Deal, Social Security, federal programs, government expansion. After 1971, Nixon closes the gold window. Bretton Woods dies. Fiat currency era begins. After 2008, quantitative easing, 0 interest rates. Central banks become the market. After this crash, central bank digital currencies, CBDCs, programmable money. Every transaction tracked, every dollar expiring, if not spent. Negative interest rates enforced digitally. Financial surveillance complete. They'll sell it as safety, as efficiency, as protection from future crises. And millions will accept it because the pain of collapse will make any solution seem preferable. Freedom traded for security, privacy exchanged for stability, and once it's gone, it's not coming back. The question nobody wants to answer: was this crash inevitable, or was it engineered? Though, is it matter? The outcome is the same. Wealth destroyed, lives ruined. Power consolidated, the system saved by the same people who broke it. The pattern is always the same. Boom, bubble, bust, bailout. Each cycle, the few grow stronger. Each cycle, the many grow weaker. So what caused the crash? Debt, greed, hubris, complexity, fragility. All true. But maybe the better question is, why does nobody ever stop it? Why do warnings get ignored? Why do whistleblowers get silenced? Why does every bubble inflate bigger than the last? Because the system isn't designed to prevent crashes. It's designed to survive them. The question is, will you?